A new report was just released outlining the shocking similarities between today and 1987, more specifically, Black Monday.
As the Dow Jones Industrials took off on a fear-fed freefall to close down a record 508.32 points.
These huge stock market crashes seem to always happen in October. So the question becomes, will we have another stock market crash this October? I'm going to answer that for you in 3 simple, fast steps. Step number 1, let's go over the Dow versus the NASDAQ. Okay, so we start off by looking at a chart going all the way back to January 1st of 1987. And this is how many days go by in the year. So here we're at 97 days, 177 days. You get it. On the left, this is an index. So we go from 100 up to 140. So if the blue line goes from here up to here, that's about a 40% gain. So we look at this chart, and sure enough, at the beginning of the year, it goes parabolic. Then it continues to go up and up and up, and then it goes down, kind of rolls over until we get to that infamous day in October, Black Monday, where the market absolutely tanks. And with a matter of a couple days, it loses all of its gains for the entire year. Now we get to the terrifying part. I hope you're sitting down for this one. Editor, go ahead and help me out and throw up a chart of the NASDAQ in 2023, and let's compare it to the Dow in 1987. And you can see it looks almost identical. Now, I know a lot of you right now are saying to yourself, okay, George, I get it, but charts often look very similar, and this could be just correlation. And I totally agree. So what we have to do is dive even deeper and look at the variables that contributed to the stock market crash of 1987 and see if we have the exact same setup today. More on that throughout the rest of this video. But let's look at some actual numbers from the NASDAQ today to see if we did have a Black Monday type scenario, how far would the NASDAQ actually decline? So right now we're right around 1350, and that's up from about 10,000 at the beginning of the year. So if we had this exact same setup play out this October in 2023, that would mean the NASDAQ in this month, right now in October, would go down by 3,500 points. Step number 2. Now let's go over to the report from Bloomberg and try to understand what caused the crash, or one of the main contributors to the crash, 1987 Black Monday, and see if we have the exact same things happening today in October of 2023. Let's go right over to that report. The author starts off by saying, in financial circles, comparisons to 1987 are never welcome. That goes without saying. The Black Monday crash in October of that year is still the single most terrifying day in market history. Any suggestion that current circumstances are at all like the early months of 1987 are a little scary. The report goes on to mention that a guy named Albert Edwards, who's a strategist for SocGen, was one of the original people to make these comparisons or notice these comparisons. But it goes on to say he's not the only one to see something reminiscent of 1987 and 2023's rally for equities, even as bond yields rose. Here's a quote from a guy named Steve Sosnick with Interactive Brokers. When I started in the business in 1987, bonds were mirrored in a bear market for most of the year while stocks rallied sharply until, of course, that reversed quickly. So let's think about this. Bond yields went up dramatically while stock prices went up as well, something that usually shouldn't happen. And it's something we have seen throughout the entirety of 2023. Now let's move down to a chart of the 10-year Treasury yield looking at 1987 compared to what we've seen in 2023. And once again, you can see this is very similar. This should come as no surprise because increasing bond yields should be very bearish for stocks. One of the main reasons is a discount cash flow model. So I know that's kind of industry jargon, but it's actually very simple. Let's shoot over to Investopedia and check out exactly what this means and why it's so important for the stock market. Discounted cash flow uses a discount rate to determine whether the future cash flows of an investment are worth investing in or whether a project is worth pursuing. The discount rate is the risk-free rate of return or the return that could be earned instead of pursuing the investment, so such as the 10-year treasury. So if you are getting, let's say, 5.5% a 10-year treasury, well, you'd have to get a lot more than that to invest in a stock that has much more risk involved. So what happens, and the article goes on to state this, is when the risk-free rate goes up, in other words, the yield on the 10-year treasury as an example, usually stock prices have to come down because those future cash flows that the business projects earnings need to have a discount, because you just can't look at an 8% return, let's say with Google. You have to compare that to the risk-free rate. So if the risk-free rate, let's say, is 1%, and you might be getting 8% growth with Google, well, that would give you about 7%. So the share price would need to adjust. But if the risk-free rate goes all the way up to 5%, now there's only a delta of 3%. Therefore, theoretically, in this modeled out world, the share price would have to come down. So you can see what happens if share price goes up and up and up while the yields are going up. At some point, the market, the S&P 500 or the NASDAQ, breaks. Now let's go back over to that Bloomberg article, that report, so we can hear from other insiders who lived through 1987 Black Monday and the similarities they see. They say the equity market's current resilience in the face of rising bond yields reminds me much of the events of 1987, when equity investors' bullishness was eventually squashed. And in further parallel, currency turbulence in 1987 played a key role in exacerbating recession worries for an equity market priced for the start of a new economic cycle. Just like 1987, any hint of recession now would surely be a devastating blow to equities. But there's many more reasons why higher interest rates on treasuries could lead to a Black Monday type of stock market crash right here in October of 2023. It's not just about discounted cash flow models and anecdotal evidence from individuals who were actually there during Black Monday and experienced it firsthand. To understand other reasons why rising interest rates might trigger a stock market crash, let's go right back to the whiteboard. In the last video, we talked about this guy right here. It's not the average Joe. Oh, no, no, no. It's his Chinese cousin, the average Ho. That is right. And unfortunately, he plays a big role in a potential stock market crash in the United States. So let's look at the big problem he has right now. We've got his balance sheet, assets on the left, liabilities on the right. He has a lot of treasuries as assets. So that's a good thing because he has a lot of dollar-denominated debt. And right now, let's say he's got one currency unit of yuan, which is the local currency, coming in cash flow. And currently, that suffices. That gives him enough of the currency units he needs when he exchanges yuan for dollars to pay off his dollar-denominated debt. But it's not just the dollar-denominated debt. You see, when oil prices go up, the average Yo has to have more yuan as well because those oil prices are denominated in dollars. The exact same thing when food prices go up. So he is being squeezed at multiple levels, especially when the dollar goes up, which is what we've seen it do over the last few months. So this puts the average Ho into a position where he doesn't have enough of his local cash flow coming in to buy the things he needs or to service his debt. So he's only got one choice. That's to sell some of the assets on his balance sheet. And if he has dollar-denominated assets, that's even better, such as treasuries. So we have seen this spike in treasury yields as a result of many things, like the Fed taking interest rates from basically zero straight up to over 5%, an unprecedented move. But it's also a result of the dollar going up and commodities going up that are priced in dollars, such as oil. So if the average Ho has to sell these treasuries, that means there's more supply, maybe the same amount of demand. If there's more supply, then the price goes down. If the price goes down, what happens to the yield? It goes up. So there's many people out there talking about how interest rates are going to continue to go up at the long end of the curve. And most of the reasons they give are completely ridiculous. They're nonsensical, to say the least. But this is a reason that makes a lot of sense once you understand the global monetary system. You realize that these entities might have to sell treasuries. It's not that they want to sell treasuries. And that could make the interest rates go higher and higher and higher, which would impact that discount cash flow model. But it's not just the DCF. It's also how this impacts global dollar liquidity. So let's take it right back to the global monetary system. We've got all these banks, we'll call them in the Eurodollar system. They've got assets on the left, liabilities on the right. These assets, a lot of times, are US treasuries. They use that as collateral to manage their balance sheet. They also use that to provide dollar liquidity, which has several knock-on effects, including propping up the United States stock market, the S&P 500 and the NASDAQ. So let's think this through. Let's just assume for a moment that this treasury is worth $1 billion. But remember, this would be highly dependent upon interest rates. So this treasury is worth $1 billion if interest rates are 1%. Let's say on this 10-year treasury that they're holding. And let's also assume that they have $1 billion worth of liquidity that they need to provide. And they're doing this with the $1 billion worth of treasuries they have on their balance sheet. Now, these aren't real numbers, of course. We're just using them to keep the example very simple. But for a moment, let's assume that the yield on the 10-year treasury, the market yield, goes from 1% to 5%. Well, what happens to the value of the treasuries that they're holding on their balance sheet? They go from $1 billion down to $500 million. And again, these aren't real numbers. We're just using them for the sake of the example. But you can see that if this bank in the Eurodollar system needs $1 billion worth of collateral to provide the $1 billion worth of dollar liquidity that the global economy needs, and the value of their treasuries go from $1 billion down to $500 million, how can they provide that dollar liquidity? The answer is they can't. So I think the dynamic of the dollar going up, also commodity prices forcing entities outside the United States to sell their treasuries, increasing interest rates, reducing the amount of dollar liquidity that's available for the global economy, is just as important to triggering a potential Black Monday type of event as the impact of interest rates on discount cash flows. Step number 3. So we've discussed how these huge stock market crashes tend to happen in October. Now, we've been discussing 1987 and Black Monday, but unfortunately, that's not the only major stock market crash that's occurred in October in United States history. Remember this chart that we showed earlier that shows where we are right now on the NASDAQ 100 compared to the exact same time of year in 1987 and how they are eerily similar. But back in 1987, they were actually comparing that year to 1929. Check this out. Ahead of Black Monday in 1987, versions of the following chart were circulating on Wall Street. One line shows the Dow Industrial starting on Halloween, 1986. That's a great date to pick, right? While the other is the Dow starting on Halloween, 1928. So look at how similar 1929 was to 1987. And then let's remember how similar 2023 is to 1987 and therefore 1929. So this takes us right back to the original question. Are we going to experience a Black Monday type of stock market crash in October of 2023? Well, there are no certainties. There are only probabilities. But I would argue that the probability is much, much higher than usual because of the spike in interest rates, more specifically the 10-year Treasury, and how those interest rates could continue to climb higher as a result of the dollar going up and the variables we talked about in step number 2. Hey guys, I know most of you realize that we're living through very tumultuous times. It's not just what's going on with the stock market. Obviously, we have big problems in the Middle East, Russia, Ukraine, potentially China invading Taiwan. We've got the government deficits exploding higher, the government debt at all-time highs. We have the poverty rate increasing. 60% of Americans are living paycheck to paycheck, and 45% of Americans making over $100,000 a year are also living paycheck to paycheck. We've got the inverted yield curve that is screaming recession. So obviously, there's a lot to be concerned with. So the question becomes, okay, George, I understand what you're saying, but what do I do? Do I buy gold? Do I buy silver? Do I buy Bitcoin? Do I buy commodities? Do I buy maybe treasuries or keep my wealth in cash? Should I buy a house? Should I maybe sell my house? Is the real estate market going to crash? How do I hedge my 401k? These are all great questions that you should be asking right now. And fortunately, I've got a solution. I've teamed up with my good friends Lynn Alden and Chris McIntosh, and we're going to do a free live stream this Friday, October 13th at 2 p.m. Eastern Time on the Rebel Capitals channel. That's my other YouTube channel where instead of doing whiteboards, I do live streams, 4 or 5 per day sometimes. But we're going to come together so we go over their portfolios, how they're investing. And if you don't know Chris McIntosh, he's one of the best hedge fund managers in the world, and he specializes in commodities. Lynn Alden, of course, needs no introduction. But if you've been living under a rock for the last 3 or 4 years, she is one of the best, if not the best, macro analyst I know. And our objective this Friday, October 13th at 2 p.m. Eastern on the Rebel Capitals channel is to give you the tools you need to not only survive, but to build wealth and thrive in these crazy times that we're living in, regardless of what comes our way in 2023 and going into 2024. So this is an event that you are not going to want to miss. Again, it's a free live stream. So you got no excuse for not attending or at least watching after the fact. And I would suggest attending live. Again, that's October 13th, this Friday, 2 p.m. Eastern Time on the Rebel Capitals channel. I'll see you there.